This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Jim Cullen runs a fund. He's been running that fund since 1983. His Wall Street experience goes back to the 60s. We're talking 5+ decades. Jim is a value guy. His firm, Schafer Cullen, manages multiple billions under management. I love these types of conversations. I love to have the conversations with the people that have been around, that have seen all the different types of environments. Yes, Jim's strategy might be different than some of the strategies that I talk about on this podcast, like trend following, but his mindset, as you will see, is very systematic. It's always worth drawing the distinction. Value is one strategy. Buying and holding the S&P is a different strategy. Without any further delay, let's jump right into my guest today, Jim Cullen, and go on a Wall Street tour of 5 decades. I hope you enjoy this conversation. You know, Jim, and going through your work, going through your career some, and understanding that you've probably got a wider perspective of Wall Street than most people. So I'm Gen X, age 53. I'm curious your perspective on what I'm about to say. To me, it feels like we've never left the dot-com bubble. And let me clarify that before you add. We have this meltdown of the dot-com bubble. We get to the fall of 2002. The NASDAQ's down 77%. We know what happens to interest rates. We know the Big Short movie happens. And then we get to March of 2009. The equity indices bottom out. And then all of a sudden, some kind of Fed stuff. And then we take off on this 12, 13-year bull. And now here we are in early 2022. Is that a fair assessment? Does it all feel connected to you?
Oh, it's all very connected. You can go back 100 years before that. Markets get heated up. They go to excess. How that plays out is different depending on how bad it gets or how excessive it gets. In my book, I started in the 1920 period. Well, then you had the build-up, radio. You had RCA, you had telephone companies, you had Standard Oil, Ford, and General Motors. All of a sudden, the market broke. I use it in the book. I use RCA as a classic. Nobody had radio. Talk about a market. They were the basically only person selling radio. Stock went up like 500%. Although we'll come all the way back to where it started from. Even though people were buying the radios, they were making money. It's just that valuation got ahead of itself. That played out, and the recession came along. Next thing you knew, you had enthusiasm. When I started, I was sitting on aircraft carriers. Said, hey, this is easy. 1961, 64, stocks went up all the time. I got out in 65. I started with Merrill Lynch in their office on Wall Street. People were flocking into the office. People were coming in there. We had to put a plexiglass up to keep the people from spilling over on top of the brokers. We had what they call walk-ins. So you had people were waiting in line to open accounts. I mean, it was excessive. And I mentioned in the book a guy named Charlie Plone. They called him 2-Day Charlie. And he would come in the morning and he'd pick up a couple of ideas coming in and create companies as he came in and do an offering. And those people were clamoring for him. None of them were ever worth anything, but it was excessive.
How did you feel at that moment? So your late 20s, early 30s?
I was great. I was happy as could be. Besides dating Pan Am stewardesses as a Navy guy, the airlines were going to be a phenomenal growth. You had Pan Am and TWA with big stocks, popular stocks. Besides the color radio, then you had color television. And you had Admiral and Motorola and all those companies. In the Merrill Lynch office, they brought 3 older guys in who were around for the prior period. And they were talking about dividends or what have you. And I used to say, these guys, they all have red suspenders. They're all smoking cigars. And maybe there's some connection between the suspenders and the cigars and dividends. I don't know. But that's all they're talking about, the dividends on Ma, Bell, and Steel. And they had nicknames for all these old companies, which had gotten wiped out, but then came back and were dividend stocks because their earnings did okay during the whole period. They just got overpriced.
You get into the early 70s. You go from 68 to 75. That's a rough period.
I have in the book a photograph of myself and 2 of the guys in the Merrill Lynch office. Headlines, New York Times, Dow approaches 1,000 for the first time. Well, just went through in one barrier after another, went through 500, 600, 700, 800, 900. 1,000 was just a number. It was a photograph of us, and the clamoring was unbelievable, and people were cheering. That was the top. The next 7 years, till 1975, you had 2 recessions, and all those people who were clamoring to get into our place at noontime when the soul would be seen, all the brokerage offices that started all over the country, they all basically were closed down. And by the end of 1975, Wall Street was deserted. And I saw a commercial the other day with a tumbleweed going in. It was a cowboy commercial. That was Wall Street. We had the tumbleweed going down the middle of Wall Street. So all of a sudden, my millennial stuff said, uh-oh. And I was with 2 of the best research firms around. I was with Donaldson, Lufkin Jenrette, and with Spencer Trask, which was the top institutional research firm at the time. And we were selling 50-page research reports on stocks selling at 60 times earnings. The assumption was, this is when we went to the Nifty 50. These companies like IBM, Polaroid, Xerox, Eastman Kodak were so phenomenal and such a lock on the market that you could buy these things at any price today. Somewhere in the future, they're going to be worth a lot higher. Turns out that was wrong. You couldn't buy them at any price.
That sounds a lot the same as the dot-com era, huh?
Not only that, but sort of interesting. At the time, they did a survey, what the average new investor, what he thought he was going to do in the market over the next 5 years, what happened. They also like 30% a year for the next 5 years. That didn't work. That wiped things out for quite a while. And 2 of the stocks, for instance, I'll give 2 examples of stocks we bought later on. Meanwhile, I founded our company at 85. So all of a sudden, in 72, 73, they peaked. And IBM, Xerox, Avon products, IBM, you could have bought it 10 years later at 10 times earnings with a 6% yield. Avon products, which was selling at 60 times earnings, you could have bought it all of a sudden 10 years later at 8 times earnings with about a 6% yield. On and on and on for the whole bunch. And actually, that was much worse than the dot-com in a way. The sell-off was much worse. And then you hit the dot-com area. By that time, I'd been around and been scarred up, beaten up a little bit. Kept writing these market letters at the end of 78, 79. Look at these prices don't make any sense. Point out that how. So then that rolled over in 2000. And you had the same situation. We bought Microsoft in 2000, and we bought it at 2012. So we bought it 12 years later at 10 times earnings with a 3% dividend yield. You wouldn't have thought that. And the company had done well all the way through. It's just valuation. And the company's still doing well, of course, and now it's gone up about 800%.
Let me keep you at that 1973, 1974. If I think about some of the noted names in value investing, I mean, Charlie Munger took, I think, over a 65% drawdown during that period. I mean, it was a really rough stretch for value investors, wasn't it? Depends on how you define it.
It's the best period we've ever had on a relative basis. We went down, but we didn't go down anywhere near what the indexes went down, but NASDAQ went down. For us, we were benefiting there from a relative outperformance. That being said, in 2000, I was answering the phone and I was getting fired about 30 times a day. Actually, I was getting fired more the year before, I guess, when value wasn't working and growth was. But we're still getting fired. And I was just telling people, sell only half, sell only half. It was a great relative period for us. And we were talking the relative story, just like we are right now. Right now, what happened when they came out with the vaccines, at that point, value started turning up. We dramatically outperformed the market, the speculative stocks, from that point on, including this year. We're 500 basis points out of the S&P. In the book, I have a point in there where value versus growth, and there's that debate that always goes on, and why value can do better, because when it trails by a lot. But what happens is it doesn't trail by so much. It stays close. It just trails. But when it outperforms, usually outperforms by a lot. That's the difference in why value outperforms over the long term. I have a study in the book which points out, starting 68, when I started, the rolling 5-year periods. The discussion is taking the volatility out of the market. If you hold a value portfolio for a 5-year time period, not the stocks, but the performance over a 5-year period, smooths out. So all the negatives basically disappear when you look at it on a 5-year basis. So you take all the periods, I think there are 25-year periods between 68 and now. Then I bracketed in that study in the book. I said, during that 5-year period, what happened to recessions and bear markets? Recessions and bear markets every single 5-year period. So then later in the book, I go into recessions and bear markets, and going into each one, you're going to look at that and you say, geez, if I could avoid that recession and bear market and time it, if I could time that, that would be ideal. what the study shows is don't try to do it because it doesn't pay. You don't need to because the performance smooths out over time anyway. Then I also do the 10-year for the bond guys. I try to get bond guys to take the strategy, but they don't want to do. They rather buy real estate for the pension funds. If you look at how smooth almost every single 10-year period, go back to 68, is between 9% and 18%, consistent. And every single 10-year period, of course, is a lot different. The one 10-year period, which we talk about is the dead decade, in 2000 to 2010. During that period, we doubled our money during that period, and the market was down. And I'm talking about our high dividend strategy, which is our most popular. The reason is because dividends are increasing a little bit every year. So the yield on the portfolio on cost, because the dividend increases and a few changes maybe in the portfolio, got up to around 8 or 9% after about 7 or 8 years. So the stocks aren't going to stay down there at that level. So that's during the period when you had the tech stocks rolled over, you had 9/11, and you had the financial crisis. Bing, all in that 10-year period. That's probably one of the worst 10-year periods that you've had for the market.
I want to pause you there for a second. So we get through that 10-year time period, and then we get this situation where the U.S. Federal Reserve says, and I assume because of that 10-year period, they say to themselves, and I'm assuming this is the conversation they had, my gosh, we've got to bring the economy back from dead. Let's take rates to zero. And there we go from 2008 until 2022. Just philosophically speaking, not even about your strategy or anything, but you as a wise market guy, 2008 to 2022 with the U.S. Federal Reserve keeping rates pretty close to zero. Is that unusual, historically speaking?
Oh, that's very unusual. Just encourages speculation. It's a difficult period for value. But during that period, we may have traveled 1% or 2% a year during, and we did better than maybe 1 or 2 of the years of the next 12 or something. But basically, they underperformed, and it was out of favor for a 10 or 12-year period of time. And that's why I wrote the book. I said, listen, who's going to make a case for it? Because it's so out of favor. I have a pension plan being managed by New England Pension up in Boston. I said, we're doing pretty well with this account. I said, dividend strategy. I said, why don't you put us in another search up there? And he said, Jim, he says, I know this account's done okay, but he said, we haven't had a new value search in 10 years. I said, it used to be anytime the pension plan was on the game out, it would have a value portion, a growth portion, bonds, what have you. There were the 3 main parts of it. But now it's all exotic land in Hawaii and what have you, all kinds of stuff that's locked in by the private equity guys, which will probably wind up eventually being a disaster.
Do you find yourself, as I bring up that 2008 to 2022 low rate environment period engineered by the Fed, do you find yourself worrying too much about what the Fed has done and having a strong opinion, or do you just stick to your knitting on your value strategy regardless of what might be happening in the central bank environment?
I get up in the morning, I have a routine, and I watch CNBC and Bloomberg maybe for an hour or so in the morning. And most of the stuff I watch on there is just a waste of time for me. But I sort of want to hear what people are hearing. I can care less what the Fed does. They're going to have it right most of the time and what have you. Ben Graham said, this is back in 1975, as the tumbleweeds rolling down Wall Street. And Ben Graham comes out with a speech. Nobody paid much attention to it because nobody cared about stocks at that point. And he said, if you follow a simple strategy of having a discipline and invest for the long term, you probably can forget everything else and just focus on the discipline. So the disciplines, low PE, low price to book, and dividend yield, those 3 disciplines. Then he mentioned long term. He didn't give a timeline, but what we had done is develop, he said 5 years. People want to know what you're talking about. We talk about long term. We feel our experience in 5 years is plenty to give you enough diversification to smooth the performance. And if you do that, you can ignore everything else. The rest of the stuff is all basically noise. The publicity it's generated, and it's sort of fun. It's exciting, and sometimes you can make a lot of money trading, what have you. You make a lot of money going to Vegas once in a while also. So, that's another world that we're not in. We're in the investment world. We're looking for earnings and dividends and book value and low debt and all that.
Perhaps the most controversial line that I saw in your book was about modern monetary theory, where you said the belief would be, quote, that every problem can be solved by printing money, end quote. It was very brief, but but I caught it.
Well, that's what they believe. The senator from Connecticut, she's the one who promotes that. There's a belief in that. It's like a drug addict, I guess. Like, keep taking the drugs, you're okay. Once you stop, you're in trouble. I went to a meeting, and a guy in the back of the room stood up and raised his hand. He said, Mr. Cullen, what do you think about the fact that you've had a 25-year period in Australia without a recession? I said, what? That doesn't sound right to me. I said, I know their market's been up and down. I'm all over the place. So I went back, and it's true. Not because of the Fed, but because of China with the buying commodities. That was their garden patch, was Australia. So Australia went for 25 years without a recession. So when people worry about recessions, I don't really care about recessions at all, whether they're here or not. But they went 25 years without one. And I said, well, let's superimpose that 25-year period, stock market on top of that. Well, they had more corrections than we had here at the same time period. They had like 6 major stock market corrections of over 25% during that same time period. It's sort of similar to ours, stock market-wise. So even though they didn't have the recession, they avoided there. They can continue to avoid the recession. At what point does debt come into play, what have you? I don't see how you avoid stagflation. I mean, I think historically, no way to avoid it. I think the inflation, because of the chaos you got internationally, because of the fact that workers have finally gotten some muscle here, and Domino's Pizza can't get any workers. Nobody wants to make pizzas for $12 an hour. So I don't know what they're going to get the people to do that, but it's not going to be a 12. And percentage-wise, the cost of that is going to go up a lot, I would think. Companies are going to be squeezed. All we know, though, companies adjust. We don't have to worry about all the stuff going on. All we have to know is that the companies that we're investing in, they're worried about it. And they're highly incentivized to grow profits. So they're going to sell off things, buy things, do whatever they do. The history of corporate earnings, going back to the 30s, is earnings tend to double about every 10 years. Maybe it's 12, maybe it's 9, but close to 10 years is within 10% every 10-year basis. So I've got all the 10-year periods, how long it takes to double. And you look at that, and you figure out where earnings are, where they were the last cycle, where the 10-year number is going to be here, put a multiple on that. That's probably should be your target where stock prices can be at X period also. I have a section in the book, at the back of the book, a point for new investors. The problem with the new investor, you look at the market, geez, I don't want to invest now because the market's too high. Or I don't want to invest now because we've got a recession going on. I have going back to 1935, I guess it is. There's always a reason not to want to invest. Either the market's too high, there's a recession, there's a war, there's something going on. Meanwhile, at that same time period, I think the market's up 60, 70,000%. So it pays to be in the game as long as capitalism is alive and well. So even if it's not as pretty as it used to be, I'm not sure capitalism has ever been pretty.
Not to throw any names out necessarily, but I've seen some value voices, and maybe they look at value differently than you, but I've seen it characterized in the last handful of months of 2022, so the beginning of 2022, the prices at an elevated level of the highest in the last 100 years, higher than the dot-com era, higher than the Great Depression in terms of where value should be. How do you feel about that?
We did that in the book. We pointed out that the 5 largest stocks make up the index, what percentage of they are of the index. And the 5 largest right now are as high as they were back in the tech bubble and Nifty 50 both. That's a general statement. I think things can play out quicker or take a longer time period. I see what Alphabet is now selling at only about 20 times earnings, 18 times earnings. In the book, we have a study on what's happened when the markets rolled over, what happened to the prices of the top companies 5 years later and 10 years later. Shocking that they're 50, 60% lower 5 years and 10 years later. When you're there, you say, I don't see how that's going to happen here. But it did. And I don't see how it's going to happen here. Well, Alphabet's already come down. Some things have already worked their way lower. So maybe I don't know how that plays into it. Tesla is a classic example of a great company doing everything right. Everybody's going to want their product. There's a big market where everybody's going to own these cars, what have you.
When you bring up Tesla, though, whatever value metrics you would use, Tesla far exceeded them. It was in bubblicious territory, yes?
Oh, yeah. And they're going to continue to do well. Remember Walmart? Walmart owned everything. Guess what the growth rate?
How could Amazon even come into existence with Walmart's dominance? But they did, huh?
Yeah. And not only that, you get the feeling that Amazon had their problems also. But Walmart, the growth rate, the last sales and earnings over the last 5 and 10 years has only been around 1 or 2%. I was shocked at that. And they reported this morning it was down. I'm saying to myself, I said, we should be shorting that stock. So I just got in the value line report on. I'm looking at it. I said, oh my God, a 5-year, 10-year number. I would have thought that was much higher than that, but they were just wiping out everybody on Main Street. Towns were being wiped out because of Walmart. They get people in the store originally to buy Heinz ketchup, but then once they get you in there for a while, they drive their own brand, trying to increase their margins that way. A lot of that's already been done. You're seeing the same thing going on with Whole Foods now. If you went there for a certain quality item, all of a sudden they don't have that quality item anymore, but they have their own substitute for that. That means they're struggling for margins. So then what happens with the large companies, once they eat up all the groundlings, all the other companies, then they start getting into each other's because they got to continue to grow. So they get into each other's businesses. Then it's like the dinosaurs start eating each other. So they've eaten all the other stuff. And that's like Walmart also right now.
For a guy like you, though, the challenge, though, is to make the pivot between the laggard and the new leader coming. I mean, you've got to make that pivot.
Graham said what he said. At the same time in Barron's, same year end, 75, the report was done in Barron's at the same time when nobody had any interest in the market. Wall Street was dead. And the Barron's had a study by a research director of one of the firms pointing out how on a decile basis, the bottom 20% of stocks on a PE basis versus the highest and the rest all the way up and down dramatically did better on a 1-year, 3-year, 5-year, 10-year basis. I was working with Dave Dreaman at the time we did the study, updated the whole study. And basically that's what we're working on. And that's what I have on the book. And basically how we look at stocks is look in the bottom 20% of the universe, whether it's Value Line's universe or whether it's a S&P, well, whatever universe, various universe it is. And we're saying, okay, within there, what stocks can we develop? Well, where's the story? And we work from that. And then we know is we want to be diversified. We don't get overweight in any one industry because we know the strategy works, but we don't want to get weighed down by technology, though we want maybe a technology stock or two in there if we can have it. Healthcare, banks, what have you. You just don't want to get overweight in any one industry, particularly, but have a diversified portfolio and have theoretically the cheapest stock with the best growth prospects in that industry. That's what you call it inexact science. Sometimes it works, sometimes it doesn't.
Let me take you back to a couple periods. We've already talked about it a little bit, but I'm just curious your perspective because they're really informative periods. The first one I want to bring up is October of 2008. We go through the summer of 2008 and we see 2 of the 4 investment banks disappear. We get to the fall of 2008, and to me, as a casual observer, it sure looked like the other 2 investment banks were going to disappear as well. And it sure looked like the guy out there in Omaha was having big trouble in October of 2008 until, for all 3 of those entities, the magic hand stepped in. How do you view that time period of the magic hand that came in and waved that wand? How do you view that situation?
What happened back when Clinton was president, the sitting president always wants to get reelected. So Clinton had some advisors from Goldman Sachs, and they said, if you get rid of these regulations, they're holding this market back. And you also have an uptick, which also ties our hands. So things that were in there since the recession, which had done a good job of sort of stabilizing markets all along, were removed. And actually, there was someone who wrote a book with our publisher, a very popular book right before me. And he said, I don't know why the financial crisis developed. Well, it's exactly why it developed, because of that moment. Once they did away with those guardrails, Goldman Sachs and the trading firms made a fortune. Guys went from being millionaires to billionaires. And they started all these trading accounts and the electronic trading, what have you. So that's what blew up. That's what caused the whole thing to break down. And you're right, they all should have gone out. Unfortunately, they didn't enforce it. So the people who were running these big banks, what have you, didn't monitor the things properly. They didn't really get punished. And the public got really mad about it. So the public was really annoyed at that point. The Omaha thing, I know Buffett stepped in, I guess, and had an influence there.
He was down big in 2008, especially in the October 2008 period. He was down big.
I mean, he was a Ben Graham guy. He got too big. Charlie Munger's more of a growthy guy anyway. He got so big that he couldn't do what he was originally doing, buying companies that were cheap on a earnings and what have you basis. So it became more conceptual. Charlie Munger's big on buying brand names. And that's why his biggest stock right now is Apple. Bank of America took over Merrill. Merrill's done. It's shocking. That's because I think they had this famous staggered board of all kinds of people on that board who didn't have any idea what was going on about the business. And the bond guy took over there as president. And the next thing they were gone. But anyway, that was a scary period. I don't know how, if they hadn't bailed them out, how it would have wound up. I mean, you certainly would have faced out anyway, one way or the other, right?
Right. For overall confidence, it would have been better if we weren't picking winners and stuff like that.
I agree 100% on that. I think they should have let him go. Not that I wanted, because I had portfolios.
We've brought up Ben Graham, and I know a big influence on you. But do you have any other, I'm just curious, you mentioned early career Navy and whatnot, but some of those early mentors for you, what took you from just being, quote, a regular guy to having a pretty successful career? I'm curious about some either early mentor or mentors along the way that really guided you. Any stories you might like to share?
Well, I started off with Merrill Lynch. We had an investment group of a bunch of guys on Wall Street. We get together. We're all millennials.
Hold on, you said millennials.
Yeah, we were all millennials. We're all like 25 years old.
Okay, I got you.
Yeah, we were all millennials. We had 4 guys, I think, from Morgan Bank, a guy from the Wall Street Journal, a guy from Barron's, a couple guys from industry, a guy from Bulova Watch. It was a mixed bag. And we get together once a month and just swap ideas. But out of that, Dave Dreeman he and my original partner, Schafer, worked at that value line. So we're all in the hype of this whole 60s thing. But then all of a sudden, I was at Spencer Trask, which was probably one of the top 2 or 3 institutional firms at the time. I mean, this was like a great country club, and the analysts were absolutely phenomenal. I mean, I used to get paid in the morning for calling hedge funds. If I called them before the market opened, the day after we had a research report, I was automatically getting business. I mean, the whole thing was insane. Just they wanted to know what the firms were thinking. And then all of a sudden it started not working. I was doing myself a lot of market timing thing because I'd read a book once about time, which I still have the book. Some engineering guy was timing using all the different indicators. And when they went one direction or the other direction, Dick Davis does some of that stuff now, but I had it refined really down. The beginning was Dream and I had lunch one day. He had been let go actually at J&W Seligman, and they were cutting back. But I was at Spencer Trask at lunch, and he said he's writing a book on value. His was contrarian. He was a big believer in contrarian view. So we were aware of the study by Graham, or I was aware of that, and he was aware of the New York Times piece where they're dividing the market by deciles. We decided to hook up, and we started our own research group with a Texas firm, which is a regional firm, which had an office in New York. And they gave us an office in New York, which we called the New York Research Group, which was value. And we worked for them for about 3 or 4 years. We're finding what we're talking about now. After about 4 years, the regional research firm closed down. They're going to close their office. We had a great run with them. They invited us down to Texas. And as much as we like Texas for once in a while, we didn't really want to live down there at the stage of the game. So Dreeman was a bachelor with an allowance. I was married with a wife and a kid, not mortgage. So I went over to Spencer Trask. And as far as I was concerned, Buffett had some interesting pieces. But one of the most interesting things on Buffett was the fact that he said, if you don't understand it, don't buy it. When you get all these computer models and what have you, and I can't figure out any idea where some of these things lead, the hedging, what have you, we've seen where hedging has been a disaster over time. 2 reasons why I wrote the book. Number one, is the return of value. And the second thing is people don't have any education at all about the stock market. Schools don't do it. Although my friend Jason Zweig pointed out, Jim, well, actually there is education. The wrong kind. They have these contests, stock picking contests. So really what they do is encouraging trading, but nothing about investing at all. Because what you see is that the trading thing is encouraged. The average guy doesn't know anything about markets, and they're perfect candidates for being fleeced. So our business is really a great marketing business.
You bring up the trading part. I want to ask you a question. Contrasted to value, some of the momentum trading out there. With value, though, you still, at some stage of the game, you have to have an exit. You will leave positions.
What we do is buy the cheap stocks that we can find on a PE base, bottom 20%. Like right now, the bottom 20% is 13 times earnings, 14 times earnings or less. And the market's around 20 times earnings. This is based on the last 12 months. We're trying to find stocks in that zone. Now, we had Microsoft in there. Now, Microsoft has up now like 30 times earnings or what have you. Once they become higher than a market multiple, we look to sell them and replace them with something new. So we're doing that all the time. We bought UPS here and we bought 3 or 4 new names here. One of the REITs bought Target not too long ago, UBS, Lowe's. So anyway, we're looking for new names that are under 14 times earnings. And then once they get over, say, 20, 25 times earnings, we look to sell them. And if stock goes up, say if stock doubles, and it's still cheap on a valuation basis, we'll cut it back to 3%. So we have roughly 33 names in a portfolio, all equally weighted around 3%. So it's always maybe up 20% turnover a year. So it's not a lot of turnover. Some years are going to be more than others because you've had big runs to the market on certain stocks. And we have about 3 or 4 stocks right now that are over a market multiple. And we have our analysts, I think we have 15 analysts now, and they're all scrambling to find new names that are cheaper that we can buy to swap. So usually every month or so, we average probably one new name that we're buying in there and swapping. And then as we'll cut back on Microsoft, we've cut back 5 different times. And I know we got 1% weighting in it, but we're still looking to get it completely out of it.
You give this nice story of you approximately age 25 with your peers all getting together and to discuss investing strategies. And you use the word millennial to describe the age you would be where people today can relate to that. Millennials today are doing something very different than you were. They are all on board with Bitcoin and crypto in a massive way. How do you feel about all that?
What do we have as a same alternative, I guess? We have what they call pink sheets. Pink sheets where all the over-the-counter stocks are listed. Guys were living off the pink sheets. Guys were looking at the exchange half the time. The young guys were all flipping through the pink sheets, and they had thousands of companies in there. It was probably 2 inches thick of just reams and reams and reams, at a phone number, a price, and they would come out like every day until they changed this thing.
You see crypto as a parallel to that, similar to that.
When crypto first came out, it said, looked like a good way to avoid taxes, looked like a good thing for crooks and people who want to do illegal stuff, which in today's world is very popular. Problem in our industry was front-running all the trading orders. So anyway, in our day, it was gold, I guess, was the alternative.
Let me frame it to you this way. So you're a sage in the sense you've been around the block. You've seen a few things. You got a few decades of experience. But a lot of these young people today, they look at some of the things that I've been bringing up with you. They look at the dot-com crash. They look at the Great Recession. And then Bitcoin starts to really take off in 2012, 2013. And a lot of them really don't believe in the system that perhaps that I believe in, that you believe in. Maybe I don't know how much I believe in it these days, but they don't believe in it really as much. They really believe that something dastardly is on the way. Are they completely out of their minds to think that?
If they're smart, what they would do is say, okay, let me allocate so much of my money towards Bitcoin, trading, and what have you. But then I should take a certain percentage and have it as an investment vehicle. I have in the book there where some of the doctors put their IRA money in their IRAs when they started. And each year they make the contributions. And for a lot of them, they didn't touch that money. It went all the way through. And now they're about $40, $50 million in those accounts. They never touched it. Meanwhile, for their own accounts, they were trading things. They were getting divorced, buying restaurants, fancy cars, fancy houses, and all that stuff. And most of these guys had nothing in the end, except their IRA account was worth for $40 million. So I think if you're smart, what you're going to do is you're going to say, okay, I can play this game and I can do this, but I should take a certain amount of money and put it aside theoretically every month. I didn't do that, but I wish I should have. Avoid going out for dinner one night a week. Instead of going out to dinner 4 nights a week, go out 2. I've done that with people with not very big jobs, important jobs. All of a sudden, after about 10 years, it starts to build up. So that's what they should be doing, separating the two. It used to be in my era also that people allocate an amount of money, even pension funds, a certain amount of money in growth stocks, a certain amount of money in value, and a certain amount of money in bonds. They were the 3 choices. They got away from that because they got the consultants giving them more exotic ideas, alternatives. Of course, that's where the big money is.
I'm calling you from Asia today. I'm curious, a little bit of a side tangent shift on you, but how do you look at, with all this value experience, you start to look around the world, emerging markets, perhaps Asia, perhaps China. How do you feel about the value perspective in some of the markets and some of the countries where things might be a lot more opaque?
We have a Raul Sharma who's been with me for 20 years. He's the captain of the wrestling team at William & Mary, and he's very intense, third-generation Indian. But anyway, we have a guy from India, actually, who's his assistant, who's phenomenal. So anyway, they do the international stuff for us. Same strategy, same discipline, same idea, same diversification emphasis by country, though, instead of industry. So it's applied the same way. It started because when we started our original high dividend strategy, we had to get companies with a low enough PE, a high dividend yield, and then dividend growth. We had a lot of utility stocks that had dividends, but they didn't have any dividend growth. So then you had to include more industrials. So once we started that, then we found if we use some of the international, the global names like Unilever and Nestle's and stuff like that, then we started including some of those. So we said, okay, we can limit our portfolio maybe no more than 20% international. We've always had a little bit of a taste for international, which wasn't much help in the last 2 years. I just did the report. We have a global where we're some U.S., some international, and then some emerging markets. And it's amazing how the last year, U.S. has done tremendously much better. This is actually a small cap portfolio. The U.S. has done tremendously much better, but the valuations, the international is dramatically cheaper on a price earnings basis, on a yield basis, and emerging markets even better yet. And the surprise is that value international really holds up a lot better in down markets as well as the U.S., mainly because you have a lot of that dividend yield. Now, the only thing you don't get in the international, in the U.S. market, I go in the book how U.S. companies have gotten so amazingly so, they continue to pay those dividends through all the recessions. And I have a couple of bad recession periods where the S&P 500 dividends went up all the way through the 2-year recession. So in the Europeans, for instance, if the earnings went down, they cut the dividend. They keep the dividends as a certain percentage of the earnings. That makes it harder for us because we're looking for dividend growth. But they're starting to change that. They're starting to realize that dividend factor is more of a factor also in investing. We even started recently international high dividend strategy. I gave a talk about 15 years ago, actually in Rome, and there were 4 of us presenting, and they had different parts of the world that were there. So I was going into the Asian group. So I was going in the Asian group. The guy who was the monitor said, by the way, I know your value, but he says, don't mention long-term and don't mention value. I said, what am I going to talk about? He said, they don't want to hear it. All they want to hear is trading. So I think times have changed. So we started this fund recently, running it for a while, but we have not really have that active. But Asian dividends, eventually you're going to get a certain percentage. The Asians are going to say, maybe this is not a bad idea. So anyway, we're just positioning for that. But those markets are more challenging, that's for sure.
Tell me if this is a fair way to characterize you after having our conversation for nearly an hour, listening to you. And I think it's fascinating in many ways for me, but this is how I would characterize you so far. And you could correct me if I'm wrong. Nothing's ever too new. The names change, the leaders change. Get a strategy. Is that a fair assessment?
And ignore all the noise and stick with the stocks. And I have 8 different chapters on what makes stocks interesting and where the best ideas come from. One of the important things, making a call away from Wall Street. In other words, once you do all your homework and research, you say, let's call somebody outside of Wall Street who might have an opinion on this thing. It's amazing what opinions you might get.
You still travel a lot?
A little bit.
We've had COVID. That's not a fair question necessarily. COVID kind of killed travel for 2 years.
I was traveling maybe once a month, once every other month. We used to run the money for U.S. tennis for years and years and years. We gave up that box. We converted to Monte Carlo's box. So I at least make it to Europe twice a year for the Monte Carlo tennis for one. But anyway, yeah, so I travel. When you come back here, you don't come back much.
Not too much. Grew up in Virginia.
Oh, really? Okay, yeah.
When you mentioned William and Mary, I was just saying my sister and my mother both went there.
Well, it's a great state, as you know. But,
it's home. Distant home now, 8,000 miles away. Where are you based right now?
I'm in New York City. I'm at the Lowell Hotel right this very moment, looking out over New York. New York's actually come Upper East Side where I am here is really phenomenal right now. I mean, the restaurants are all started with the outdoor serving, but now they're going to continue forever now, I think. But it makes the whole Upper East Side, on this area at least, so much more attractive. It's like you feel like you're in Paris in a way. There's like 20 different restaurants. Everybody's got people sitting out front, what have you. We have all the shopping, of course, on Madison Avenue here. Downtown is great. A lot of young people downtown. The problem is in New York, people don't want to take the subways right now. Corporations are having a hard time getting people back, including us. We're talking about doing Tuesday, Wednesday, Thursday. And that's going to be more for the research people, I think. But anyway, I think Morgan Stanley, JP Morgan, then we're trying to get everybody back. They're not successful in that at all. One of my guys was over at Morgan Stanley the other day, and he said, They had a whole floor there where usually they have all kinds of people. He said the only people there were the people for their meeting, which was like 3 people. The rest of the floor was empty. They're having a hard time getting people back.
Paying a lot of rent for empty space.
Oh, yeah. Meanwhile, the building going on is also unbelievable. We have this new area they're building up in New York, and there's like 7 or 8 different cranes up in the new building. And you say, who the hell's going to be in these places? I write market letters 3 or 4 times a year. But I went into the era in the 90s where the see-through buildings in Florida, where all the condos were owned by the doctors and business people. You go down there and you see this building at night, there wouldn't be one light on the whole building. Well, they said, well, it's sold out. So speculators on these things. So I think the speculators are buying a lot of the space. I know the Chinese were very big on some of these high rises here. It was a way for people to get money out of the country, I guess, and in here. But I think the building in New York is going to be overdone.
We haven't really discussed real estate today. I can think back to 2008. At the time, I was in San Diego. And then when that all imploded, it was like, wow, San Diego, Arizona, Miami, all the hot spots just took it on the chin. Now, what was amazing, though, is, again, I brought this up earlier, but once the Fed did the dropping things down to zero, basically all those places sprung back to life. How do you feel about real estate in general?
I think it's going to be terrible. I think it's going to be ugly when they're done. They're locking people up. These private equity guys are locking people up in this real estate thing. And you go over a building here and you say, it's over 50% sold or 60% sold, but they take offerings, but people can back out of them also. It's going to be overdone, that's for sure. In New York, I don't know about regular housing and what have you, but I think in the cities is being overdone.
I have a hard time imagining if New York is overdone, that there's not going to be significant areas of the rest of the country overdone as well.
And that's a little bit of our competition from the private equity guys. Pension funds are going into all these different alternatives. I think that's not going to be pretty at the end.
Your mantra is like, look, let's stick to our knitting. Let's stick with our value investing, and we're going to steer clear of every other newfangled thing on the horizon. Is that a fair assessment?
Yeah. I have in the book the article on the derivatives and how the subway workers' pension plan was run by actually a European bank. They, I guess in a competition, gave the account to this loose, what they call strawberry or what have you, portfolio, which would do well in up and down markets both. And it turns out it was leveraged and they had options on it, protect you on the downside. And all of a sudden when the market broke, 2 years ago, they lost 90% of the value on the portfolio. So it didn't work. So there's a lot of stuff out there like that, where you have a lot of these ETFs, which are leveraged. And if you're going to use a 1, 3, 5 year period to judge performance, the guy who has in a hot market, the guy who has the best performance probably is leveraged up. He's probably bought the hottest stocks, and that's going to backfire on him. I have in the book here, when I was at Merrill Lynch, our first meeting I went to with a foundation, and I went with a local broker, one of my senior brokers in the office. He took me along and he said, here's 5 different mutual funds. Foundation people were looking at them, and one was a lot more than all the others. And the guy said, why wouldn't we choose that one? And that's the one they chose. Of course, 2 years later, it was belly up because it was leveraged, which is why they had the good performance, and they had options on it. One thing that Graham said, if you don't understand it, don't buy it. And there's a lot of things out there that people are buying that they don't really understand. They're being sold something which is not the whole story.
I just saw this Luna Terra stable coin crypto thing lose 60 billion in a week. Crazy. 60 billion in a week. Gone. Vaporized. It literally was in one day. The chart was one day. It used to be like a gradual come down. March of 2000 to the fall of 2002, a gradual drop of the NASDAQ. This is one day gone.
On stocks, we don't have any specials anymore. So it's all computerized. So the swings you get are going to be extreme. But as long as you're not leveraged up and you're not borrowing on your portfolio, it'll bounce back based on earnings. And the stock goes from 12 times earnings to 6 times earnings, and you're earning X amount. All of a sudden, you're getting a 20% return on your investment. It's not going to stay there very long. It's going to go up, no matter what's going on in the outside world. So that's the key to value investing, really, is what return you're getting on your investment based on earnings.
The book, The Case for Long-Term Value Investing, a guide to the data and strategies that drive stock market success. The book can be found at all those fun places like Amazon, all that kind of stuff. Jim, is there a website you'd like to send people to? Where can we direct them to find you and, I don't know, come to your door, beg for a job? What website can they find you at if they might like to check you out?
Our PR firm will know that, not me. They want me to sell some books. I just want to get the word out to my clients and the people who work for me and what have you. And the rest of it will hopefully take care of itself.
Easy to find you, easy to find your firm. And if they want to check you out and see what's going on.
I went to my local bookstore, this was years ago when I first started working on the book, and just checking out the financial column in the local bookstore. And it kept getting smaller and smaller every year. There's nothing there now. I'm embarrassed to even give them my book. It'll be the only one on the shelf. But that's going to change, I think. People come back to investing. Unfortunately, it's been longer than we'd like, but the numbers have been much stronger in the last year and a half. But the thing is, in schools, kids don't get any direction at all as far as investing. They just get this stock market contest. Who can pick the best stock? The market's going up. The most leveraged, most speculative stock is going to do the best. So it makes it easy to win the contest.
So many young people today, I know plenty of them. Literally, I know multiple people in their 20s and 30s that have made 7 figures plus on crypto or some kind of meme stock. When that story happens, it spreads like wildfire with social media apps. And then everyone's like, well, why can't I be the next lottery winner?
I guess we had some of that in my day. We had new issues were a big deal. They have something called letter stock. If you get letter stock, that was stock companies before they went public. So that was a get rich thing. So you've always had that. I guess in tulips, you had a prettier colored tulip. There's always something that gets the fancy. Think of the guy who bought RCA when it went to 500. The chances are a lot more people were buying it when it went down. And the same way you're going to see in crypto, the same way in the most speculative stocks. You get a bunch of believers in the beginning. They wind up catching it right. And then all of a sudden the public gets involved. All of a sudden you get liquidation on the thing. So that probably doesn't change. There's always something that's going to get people's attention. Actually, when Trump first came in as president, there was no interest in the market at all at that point. And then the young people really turned off because of the election thing and also the way the financial crisis was handled. People hated Wall Street. But then all of a sudden, as you say, Bitcoin started and then the marijuana stocks, and that got people interested. And then gradually they got into sports betting. And then gradually Robinhood came out, and then they got big into the market at that point. So there's always going to be, there was in the 60s the same way. We had Charlie Plone, 2-a-day Charlie.
Did you avoid all this crazy stuff when you were younger?
Well, I didn't have enough money, actually. Guys who inherited a lot of money and what have you, they saw that disappear pretty fast, eventually. By the end of 1975, when the tumbleweed rolled down Wall Street, there was nothing going on. In fact, I said to somebody the other day, I said, I'd like to paint that stock exchange. Our offices were right next to it. Barron's was there. And then down from that, there was a small little bar called Harry's. This is a bar that the guy was giving credit to people who had no money. And that was the only thing that was going on Wall Street at the time. Everybody was out of business, basically.
You've got some perspective. It's fun listening to. I've bounced you around how many decades? 4, 5, 6 decades here. So it's fun, though, because that gives people perspective. Because you're being very honest in the sense that you're saying, well, you know, we had some crazy and speculative investment opportunities when I was younger, too, as opposed to say, oh, you know, it's only Bitcoin. It's crazy stuff's only now. And you're like, hold on. We had pink sheets by the thousands. Listen, I've already kept you too long. I appreciate you coming on. Give me some color and some perspective. Again, The Case for Long-Term Value Investing is the book. People can find it everywhere.
Okay, well, if you get to New York, stop by and visit us.
Absolutely, Jim. I appreciate the invite. Listen, you take care. I appreciate you coming on.
Okay, buddy. Thanks an awful lot.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.